All right, let's jump right into this explainer. We're looking at a massive financial mystery buried deep inside the European power grid. A recent, pretty fascinating piece of research by Clemens Stiele has exposed this incredible dynamic in the electricity markets, and we're going to explore exactly how millions of euros are just quietly moving through the system, literally right under our noses.
Because think about it, are everyday consumers actually subsidizing Wall Street traders through their monthly electricity bills? Well, it turns out a well-intentioned regulatory tool, one designed to protect against price shocks, might actually be acting as a giant wealth transfer mechanism. And that money? It's moving from the pockets of ordinary households straight to savvy financial traders.
Section 1. Volatile power, risky business.
So here's the absolute foundational rule of power markets. We just can't store electricity economically at a massive scale yet. You generate a megawatt of power, you got to use it, like almost immediately. And because of that, spot market prices can be incredibly chaotic. I mean, spiking dramatically or even dropping below zero just because it's a cloudy day. To survive that kind of chaos, energy producers and retailers desperately need insurance, which they get by locking in prices on what we call forward markets.
But, not all forward markets are created equal. Take Germany and Austria. You've got Germany with this highly liquid forward market, huge trading volumes, lots of buyers and sellers, super low transaction costs. But then you look right next door at Austria, and it's highly illiquid. So if you're an Austrian energy company trying to ensure your future sales, you're often going to cross that virtual border and desperately try to hedge your bets in the German market instead.
But hedging your bets in the neighboring country brings up a whole new problem. We call it basis risk. Basically, this is the risk that spot prices in those two connected markets, Germany and Austria, just suddenly split apart. If an Austrian power plant sells its electricity forward in Germany, their payout is tied to the German spot price. But they're physically selling power in Austria. So if the Austrian price drops while the German price spikes, their financial hedge is totally incomplete, and they could lose a lot of money.
Moving on to Section 2. The interconnect fix, LTTRs.
So regulators obviously saw this basis risk issue and thought, okay, we need to build a bridge here. Enter the LTTR, or long-term transmission right. To cut through the jargon, an LTTR is basically a financial tool that behaves just like a European-style financial call option. It pays out based on the hourly spot price spread between two neighboring markets. Regulators introduced these to help physical energy producers financially hedge against that basis risk, keeping the power plants safe.
But well, here's where those best-laid plans kind of fall apart. These LTTRs have some pretty severe design flaws for physical hedges. First, the maximum maturity is super short, just 1 year, meaning you can't really use them to secure long-term project financing. Plus, there's absolutely zero secondary market to sell them if you change your mind. And worst of all, they have incomplete financial firmness, which is just a fancy way of saying if the grid has a major issue, you might not even get your payout. So physical power plants step back. And when they step back, purely financial traders step right in.
And just look at this number. Negative 3.2 euros per megawatt hour. Because financial traders demand a premium to take on this risk without actually generating any power, the auctions consistently clear systematically lower than their true value. It's basically a built-in discount. That negative 3.2 represents the average underpricing of monthly LTTRs in Germany compared to the actual forward market.
Section 3. The arbitrage loophole.
Before we get into the exact strategy, let's just quickly ground ourselves on arbitrage. Very simply, it's buying an asset in one market and simultaneously selling it in another for a higher price. Because you're executing both trades at essentially the exact same time, you lock in a risk-free profit, totally regardless of what the market does next. So what's the trader's playbook here? It's literally 3 simple steps. Step 1, the trader hits the LTTR auction and buys that transmission right at the discounted, underpriced rate. Step 2, immediately after winning, they jump to the forward market and sell the corresponding forward spread at its full, higher market price. Step 3, they hold both positions until delivery, locking in a nearly risk-free profit from the gap between those two prices. Easy, right? Now what's super fascinating is we can actually model this behavior using the Bachelier option pricing model. If you notice in the top panel, see how the time value, that shaded area, expands as price volatility goes up? The option is literally becoming more valuable to hold. Because of this, as we see down in the bottom panel, while traders' real-world positions are slightly smoothed out by things like transaction costs, the golden rule holds up perfectly. To execute this arbitrage, traders predictably short the high-price importing market and go long on the low-price exporting market.
Section 4. Catching traders in the act.
All right, so the math clearly says this is what they should be doing. But if traders are truly buying LTTRs and instantly hedging them on the forward market, we should see massive, unnatural market activity the exact moment those auction results are announced. So, do we actually see that?
We absolutely do, and the data is just stunning. Check out the trading volumes for German-Austrian spread futures here. See those little pink triangles up top? Those mark the exact days the LTTR auction results are published. Now look directly below every single one of them. Boom! Massive, towering blue bars. Enormous spikes in trading volume. This proves market participants are absolutely flooding the exchange to execute trades the split second that window closes and results go live.
And look, this wasn't just some loose correlation. The researcher meticulously ran a highly rigorous panel regression from 2018 all the way to 2025, using daily log returns of EEX futures to isolate this specific effect. We're talking controlling for changing gas and coal prices, wind and solar generation, equity markets, and even strictly controlling for the massive distortions of the 2022 energy crisis.
This event study illustrates the timeline perfectly. Day 0 is the auction publication. See how that data point on day 0 dips noticeably with its error bars completely detached from the baseline? That shows a massive, statistically significant negative impact on German futures returns overnight. But by day 1, it instantly vanishes, popping right back to 0. Traders are absorbing that arbitrage gap in one swift move, cashing in the very second they can.
And just to make absolutely sure this wasn't some crazy fluke, they ran a placebo test. While those front-year futures are reacting wildly to the auction, look at the blue squares representing the second-year-ahead futures, sitting perfectly flat on the 0 line. The auction strictly affects the specific year-ahead futures tied directly to that LTTR, and absolutely nothing else. Coincidence? Completely ruled out. It really is a fascinating tale of two markets when you break this data down. In Germany's highly liquid market, those arbitrage trades are easily absorbed, creating that clear, immediate price effect we just looked at. But over in Austria's highly illiquid market, even though we still see those identical massive volume spikes on auction days, the actual price impact is muted. The market is just too thin to efficiently price in the arbitrage the same way.
Section 5. Who pays the bill?
So you're probably wondering, why hasn't the free market just closed this gap on its own? I mean, in classical economics, arbitrage opportunities vanish as more people jump in. But here, we have strict limits to arbitrage. High transaction costs and complex margin requirements basically lock everyday participants out. Plus, there's an inelastic LTTR supply. Grid operators only issue a hard capped amount of these rights. The market literally cannot fix itself.
Let's actually track this missing money step by step and see the real-world consequences. Step 1. When traders buy the LTTR at a discount, grid operators essentially lose that arbitrage gap. They're selling an asset for way less than its true market value. Step 2. Because of this shortfall, the grid operator's congestion income pool shrinks significantly. And step 3, since grid operators are allowed to pass their costs along, that missing revenue is made up by charging consumers higher grid fees on their monthly bills.
The researcher is incredibly blunt about this dynamic. The paper concludes, quote, "The rents earned by LTTR holders are financed from congestion income, indicating an inefficient regulatory intervention and a transfer from consumers to LTTR holders. It really cements the reality that ordinary people, just paying their light bills, are unknowingly funding these complex financial trades."
Now, yes, it's true that financial traders participating in these markets do provide a slight one-off boost in forward market liquidity, but we have to weigh that against the reality of the mechanics we've explored today. So, I'll leave you with this question. Is a marginal increase in market liquidity truly worth the hidden cost of higher grid fees for everyone else? It definitely makes you rethink the true everyday costs of complex financial engineering.